The idea that this global growth recovery story that could play out in the back end of this year isn't priced in. EM, decent bid through this year. Asian fixed income, great bid through this year. EM performing really well through much of 2019, together with all these other things that just spell out to me, Kathy, that actually I think part of the market is positioned for stability this year, isn't it?
Oh, I think so. I mean, when you look at EM, whether it's on the credit side or on the stock side, you know, you're seeing a lot of optimism there, and I think some of that's on we're going to get a trade agreement, you know, economic growth is going to pick up, China's going to stimulate again, and that all may be true, but I think a lot of that seems to be priced in, and what isn't priced in, I say, is a widening in credit spreads. So we just don't have a cushion, certainly in the fixed income market, to protect you if things don't go well.
This is what I struggle with, Mike. You can have the consensus view that global growth is going to slow down, but the story, and just in terms of the price action through 19, is actually a market that looks increasingly positioned for stability. You see it in credit spreads here in America. You see it in Chinese equities. A variety of asset classes in a variety of regions positioned for stability and growth. Does that make sense?
Makes perfect sense. So, you know, last year our narrative was rolling bear market. Don't fight the Fed, and that's what happened. Which is why, you know, we had great earnings, but multiples contracted. So our call at the beginning of this year is we were going to have a rolling bottom, meaning the things that got hit the hardest last year would have the biggest rebounds first. And that's exactly what's going on. EM cyclicals, you know, now banks at the beginning, now they're kind of giving back some of that, you know, some of the industrial stuff. So that's how we're positioned too. We're long value over growth, and we're long cyclicals over defensives. Last year we were long defensives over cyclicals. So once again, you know, the market is much different than the fundamentals. So in other words, we're kind of more negative than most people on the fundamentals because we think it's just going to, people aren't acknowledging the deceleration, but the market's already figured this out. So we're not that bearish on stocks. We actually think, you know, we want to be buying any kind of pullback if you ever get one, which we may not. And we were big buyers at the beginning of the year, loading up on the early cycle type stocks. So it makes perfect sense. Just be a little bit careful about kind of, you know, your entry points, because this is not early 2016 where you have a mid-cycle U.S. economy, a lot of slack in the economy still. We're really still a later cycle, and it's just in the margin story, which once again, the fiscal, I agree with Jason, the fiscal stimulus is still having an impact on the economy, but the second order effects of the tax cuts are unequivocally negative. It creates price competition and creates cost pressures because you overheated the economy, and that's what's weighing on earnings. That's why earnings are worse than the economy right now, and that's what the market picked up in December, and it's going to continue to weigh on certain stocks.